Hi, welcome to my channel. Today I want to share with you my updated analysis of Amazon. They reported fourth quarter and fiscal year 2021 results on the 3rd of February after closing, and the stock jumped 12% before it opened on February 4th. As you can see here, this is what happened with the stock on the day they reported, 12% jump. And it's interesting because this is what happened on the previous day, and this is an 8% drop approximately due to Facebook or Meta reporting poor results for the fourth quarter and the fiscal year as well. This shows a little bit the irrationality of the market. There was no new news about Amazon, but even though the market assumed that whatever bad news from Facebook was going to be probably bad news for Amazon as well, or any other company that is in the same bucket as large tech companies. Then, well, after they reported, which had no bad news and probably some good news, the stock recovered most of what it shed, and even a little bit more on top of that. So the fourth quarter report had some good news, like this one, that they are increasing the price of Amazon Prime. Also, the profits were much higher than was anticipated, but this is mainly due to the pre-tax gain on the company's stake in the truck maker Rivian, which is 11.8 billion appreciation of that investment out of the 14.3. So it's almost all of that was due to Rivian, and this is of course just temporary. The only true value to Amazon on this investment is the fair value of Rivian, and that doesn't change that dramatically quarter to quarter. So this is not something that I would consider as good news. And then also some of the results in sales were a bit softer, but not as soft as they feared for online stores, and the same thing for third-party sellers. So we are going to dig a little bit deeper, and we're going to go to the financial results and conference call slides. We're going to start with net sales. Net sales came at 137 billion, and this was in line what they have guided in the 130 and 140 range. The next quarter they are guiding at approximately 112 to 117 billion, so I'm assuming 114.5. And if we compare that with the previous quarter, that would be a 5.5 growth. So you can see that the growth is much slower than the one that they had this quarter. And if we go back a little bit further, a few quarters, the growth before was 43% from the first quarter 2020. So this 5.5 is on top of a 43% growth. And this is something I already discussed in my previous video and when I did the third quarter review. To me, this 5.5% growth is a really good one, because this means that all the people that came to buy online in the pandemic periods around here, they're still buying online and even growing. So this is quite good. If we go to net sales on a trailing 12-month basis, they came to 469 billion for the year. And if we compare that with 2 years ago, in the fourth quarter of 2019, it was 280 billion. And what I want to show you here is that even though there has been like a 60% growth in this period, almost in these 2 years, you see this pie, which represents the segments of North America, International, and AWS, still holds the same proportion for each of them. Almost, this is 12 and this is 13, and this is 27, this is 61, and this is 60. So all of these businesses, even though there's been a big growth here, all of them are growing at the same pace, roughly. And now if we compare that with the previous estimation of trailing 12 months, and this is what I presented in my previous video, I was expecting 462 and a 20% growth, and they came a little bit better than that. So to me, the reports on sales are as expected, so I won't make any changes on my projections other than updating the new information for the fiscal year 2021. If we go to the different segments that they show, online stores, physical stores, third-party sellers, subscription services, advertising services, which is now being open from other. Before other and advertising were the same segment. And you can see that really 93% of what was other before was advertising services. Before they had said that advertising services was the majority of other, but we didn't know whether it was 75% or 80%, but now we know it's almost everything, 93%. So this is good news because advertising is a growing business and is a high margin business. And then here we have AWS as well. So these are the growth of each of these segments. As you see, online stores decreasing, physical stores increasing and accelerating from the past. Then we have third-party services, subscription services 15%, advertising 32%, which is a high growth, high margin business. And then AWS accelerating to 40%. And other, this is very small. And this one is if we remove the Forex exchange impact. And you can see that they had a 1% impact on Forex exchange on this quarter, this year. So let's go to this same table, but going back to the third quarter of 2017 to have a little bit more of context on the growth and whether they are accelerating or not. But this is difficult to see here, so I'm going to show you in a graphical form. So first, we're going to show the largest of the segments, online stores. And you see this is the 1% drop that we can see here. But if you see that on a longer term, it's been accelerating quite fast. The same thing happens for third-party services, which grew 12%, but if we go back, it's accelerating nicely. AWS, which is growing quite consistently. And then if you see, this is the scale, 70 billion. I'm going to change the scale now to show you the other segments. And this is the advertising and other, which before were reported on only one line. As I said, 90% of this approximately was advertising. And now we can see advertising on its own, and it's growing really, really fast. And then the other two segments that they report, subscription and physical stores. You can see that advertising is now larger than subscription. So advertising is the fourth largest of the segments in terms of sales. Okay, so here everything is quite good. If we go to the operating income, well, you can see that the operating income is dropping. This is something that we already discussed in the previous video that I'm going to leave a link in the description and up here. But they came a little bit better than expected. We were assuming, if we go back to that, this is the slide I showed back then, 0 to 3 billion was the expectation. This is the previous estimation, and they came with 3.5. And this is what they are guiding, between 3 and 6 billion. So from 8.9. So still we can see a drop. And this is because inflation, lost productivity due mainly to labor constraints, and the lower fixed cost leverage on fulfillment network. These are all things that we discussed in the previous video and they discussed in the previous call. And so all these headwinds are still going to last until most of the 2022 year, fiscal year. Maybe you recall from the previous video, I said that all these extra costs, the company was absorbing them and they were not passing that to the customers. But now they have to, at least in one instance, pass that to the customer through the increase of the price of Prime, at least in the US. And they are saying that the expansion of the Prime member benefits is the reason why they are increasing the price, and not necessarily inflation or any other of those issues. They mentioned that back in 2018, when was the last time that they increased prices for Prime, there were 40 metropolitan areas with same day shipping, and now they have 90. And also they have expanded the Prime Video catalog and other benefits for Prime members that, in their view, merit an increase in price. Let me show you now Brian Olszewski in the fourth quarter earnings call talking about these issues.
So, there's a lot of expansion that's been going on in the network, and we feel good about the basic contributors of profitability. There's, if you step back, there's procurement margin and working with vendors and sellers as well. There's, fees in some cases for 3P services and Prime, as we just mentioned, is going up. Advertising has certainly added a layer of contribution over the last few years. So if you take those are all stable and strengthening areas. It's really the onus on us is to get our operational efficiency back in all of our areas of cost. But we do see the sun coming out and getting better here over the next number of quarters, and that's going to be where we're going to put a lot of our effort.
So I don't see any major problems here with the operating margin. I think this is temporary. And the same thing happens with the free cash flow. The free cash flow, of course, has been suffering in part due to the increased capital expenditures, but also due to the increase in the operating costs, as we mentioned before. So also I don't see any problem here with the free cash flow. Remember that the company has doubled the fulfillment capacity in the last 2 years. And of course, that represents an increase in the capital expenditures, but also the fact that the operating income is under pressure as well. That puts pressure to the free cash flow, at least in the near term. I don't see any problem really for the company. I think this is all temporary, and the management has explained it quite well. So let's go now to my projections and the income statement projections. I'm just not changing much here, other than as I said, the numbers are going to be based on the actual figures of December 2021, and this is the EBITDA that I get for December 2031, 285 billion. The cash flow statement, I haven't done much either here, other than tweaking the actuals a little bit, but in the end, in the 2031 period, I get a similar number than what I was getting before. So this 157 billion in free cash flow and this 285 billion in EBITDA are the numbers I'm going to use for my calculations of fair value. In EBITDA, December 2031, I am assuming 285 billion and free cash flow 157. These are similar to the numbers I had in my previous update. I'm not changing the ratios. And so then this is the average price I get for 2031. If I put that into this cash flow for the investor, buying at today's price, which is as of February 11, 3,066, and then selling at the average that I am computing, and then including this free cash flow per share adjusted, then I get this IRR for this price, almost 14%. And then if I change this price, the entry point, let's say to the investment, I can even go to 135% of today's price. That means roughly 4,100 to get approximately 10%, which is my goal. And so this to me would be the new fair value of Amazon, which is very similar to the fair value I had before. And it represents price to fair value of 0.74. So I had a 26% margin of safety. If we compare that with the one I showed at the 30th of October in my previous video, the fair value was higher, but the price to fair value, the margin of safety was smaller because the purchase price was higher. So the company has dropped almost 10% in price since then. and in fair value it has dropped less than that. So as you say, this is just a tweak in the projections, nothing serious. The company still have the same quality that I analyzed in my video back in March last year, or 9 months ago approximately. So I'm going to leave a link here in the description. So if you want to check all the qualitative attributes, they are still valid today. None of them has changed. In fact, I think that many of them have even improved. So as you see, Amazon is still, I think, a company that it's a good investment. It's a company I like. It's a company to have. I have been an investor for 9 years probably in the company, and I am happy to be probably 9 or 20 years more, hopefully, if things don't change dramatically. This is the largest position in my portfolio, so I'm not sure if I'm going to add more. But in some of the portfolios I'm handling, I'm adding it, and it's a great business. Nothing new from the previous update and from my 9 months ago video, I think. So that's all. I hope that you liked this video. I hope that you found it interesting in some ways. And remember, please, to subscribe if you haven't done so, and to give it a like to the video if you do. And thanks very much for watching. I'll see you next time for another valuation video. Bye bye.